would be followed, and anyone who has to ask questions may please WhatsApp. And please keep your mics on mute mode unless you have to ask the questions. Over to CEA, please.
Hello, good afternoon, everybody. Please do keep your microphones mute. I do hear some external noises. Those of you who have not muted your microphones, please mute them now. Thank you. May I request those who are not speaking to mute their microphones, please. Thank you. So, good afternoon, everybody, and I'm very happy to be in front of you virtually to share with you some highlights. As you know, the data came out roughly about an hour ago, and it not only included the data for Q3 of the current financial year, and also it gave us the second advance estimates for the full financial year, 22-23, the third revised estimate for 19-20, second revised estimate for 2021. Excuse me, one of you is doing some adjustments with the microphone on. Hello? Please mute your microphones before you move your chairs or tables or whatever. Thank you. So along with this, we also got the third revised estimate for 2019-20, second revised estimate for 2021, and also the first revised estimate for 21-22. So there's plenty of numbers to chew on. Therefore, we need to abstract from the numbers and focus on what the data in general broadly tell us. So first of all, I think it is important to know that the Ministry of Statistics and Program Implementation have revised their... Is okay?
Yes.
So it is important to note here that the Ministry of Statistics and Program Implementation has maintained the real GDP forecast for the current financial year at 7%. So if you look at the fact that the third quarter GDP estimate came in at 4.4% year on year, real GDP I mean, it is also because of the revisions made to the previous years when the base had gone up in constant prices terms. But overall, the growth rate that we need to achieve in the fourth quarter is roughly of the order of only about 4 to 4.1% to be able to hit a 7% real GDP growth is something to keep in mind. And the trends that we have in terms of high frequency data for 22-23 in the current fourth quarter, for which 2 months are already going to be over soon, do indicate that achieving that growth rate in Q4 is well within the realm of possibility, and therefore the 7% real GDP growth estimate for 22-23 is very realistic. So we maintain, as we have mentioned in the economic survey, the growth forecast at 6.5% for 23-24. If you look at where we are, in terms of the advanced estimates, manufacturing on the face of it appears to have slowed down in real terms because of the rising input costs, etc. But again, if you look at the PMI indicators, purchasing managers indices, the manufacturing sector is in good health, and the performance of the 8 core industries in the month of January also tell us that we do have a fairly robust manufacturing growth rate in the fourth quarter, because the combined index of 8 core industries increased by 7.8% in January, highest in the last 4 months, compared to a 7% change in December, compared to a 4% change in January 2022. So you can see the trend in the core industries production as well. The growth momentum has carried. It is the base effect that has given us the 4.4%. But as I said, you need to abstract from the numbers and look at the high frequency indicators, which show continued growth momentum as well. There is a broad-based growth across agricultural. Manufacturing is indeed, after the Q2 setback, is coming back. Services and agriculture showing a steady growth. Capital in India, we must always remember, since the quarterly data are not seasonally adjusted, quarter-on-quarter changes need to be looked at with considerable amount of caution, I would say so. Overall export of goods and services, again, if you look at the data we have for the first 10 months of the year, we are around 369 or 370 billion dollars in merchandise exports for the first 10 months. And that is showing a growth rate of about 7 to 8% compared to the previous financial year. And services are running at $272 billion. So if you look at the overall trend for the current financial year, export of goods and services combined might be closer to $750 billion, $750 billion in 22-23, compared to $670 or $680 billion in the previous financial year, which again, in the light of the sharp global growth slowdown in 22-23, is a very creditable achievement as well. Inflation is softening. The pass-through from wholesale prices has run its course. Of course, we know that there have been some slight uptick in the inflation data for January, and RBI also has maintained its forecast that inflation will come down gradually. And we do have some uncertainties related to now the monsoon because of the El Nino activity, etc. So it is something that where we need to be ready with both supply side and monetary policy measures in the course of the next financial year. In terms of high frequency data, as I said, demand is picking up. If you look at the April to March numbers for 21-22, in terms of two-wheelers, 179 lakh units in 21-22 has already close to being surpassed with 10 months of data in 22-23 at 166 lakh units of two-wheeler sale. And the sale of tractors indeed is attaining new levels, as you can see on the right-hand side. Now, in this slide, I am presenting you multiple indicators: passenger vehicles, housing launches and sale, aircraft passengers handled, and commercial vehicle sales. All of them are moving in the right direction. In terms of aircraft, those of you who have been traveling lately would have observed it anecdotally as well. And what is heartening is that the real estate sector, which also had a fairly tepid decade in 2011 to 2020, is now bouncing back strongly in terms of number of lakhs of units of launches and sales in the calendar year 2022. So I think the point is, while the GDP data is pointing to, may I have those who are not speaking, please mute their microphones, please. So in terms of GDP data, as I said, quarter-on-quarter changes are relatively less consequential than looking at the broader picture. And we also got in the course of this week earlier, the Ministry of Statistics released the 21-22 data for annual data for urban and rural employment. The unemployment rate is coming down and the worker population ratio is picking up. And if you look at the EPFO data, the net subscriber additions up to December, the yellow line, is running well above the previous 3 years of data, which clearly shows that jobs are being created at lower salary levels as well. And the e-Shram portal registration having reached 28.6 crores, the significance of that is those who register in the e-Shram portal are eligible for social benefits that the government provides. So there is a certain transformation of the informal economy into the formal economy, because they now register themselves, they become eligible for government social benefits, they can receive them better directly into their bank accounts, etc. But it also provides an avenue for them to secure contract jobs or permanent jobs, as the case may be. So the formalization of the economy, which has been noted by many newspapers and journals and magazines as well, is reflected in the registrations in the e-Shram portal. If you look at the annual data, you can see that the rural unemployment and the urban unemployment rate and the overall unemployment rate as well have indeed come down. On the top left, labor force participation rate, rural, urban, as well as the overall all India is picking up. There is someone who has not muted their mic, please. Someone who has not muted their mic, please do so. Share of agriculture in total workers is after a rise during the pandemic years because of the return of some urban migrant workers to rural India, is now once again resumed its downward trend, as we can see in 21-22 on the bottom right. I already spoke about the export numbers for FY23. April to January data is around $369 billion for merchandise goods, and the merchandise trade deficit is coming down. So far, notwithstanding the recovery of the Chinese economy after their withdrawal of COVID restrictions, oil prices remain well behaved, and naturally India's merchandise trade deficit, which was running at $30 billion in the around the third calendar quarter of 2022, has been steadily shrinking, which obviously relieves the pressure on the external account. But the services trade, as you can see in the slide, services exports are picking up. So are overall FDI flows, which in the current financial year until about the third quarter, based on the RBI monthly bulletin, we do see that it is just a tad lower than what it was on a net basis compared to the previous financial year. But overall, for the current financial year, we might end up with a number that is closer to somewhere between $40 and $45 billion of net FDI flows, net of what goes out from India. Forex reserves, after having dipped all the way through October 2022, picked up again, and because of the slight withdrawal of portfolio flows in January and February have shown a slight decline in the last few weeks. But nonetheless, whatever concerns people have with respect to India's external situation at the moment seems somewhat unnecessary. It is something that we need to keep a lookout for, but there is no need for exaggerated concern given the number of months of import cover we have, and the fact that most of the external liabilities that are due for repayment will be rolled over because most of them are in the form of trade credits as well. In terms of fiscal policy, I think you all saw the budget, but it's important to keep in mind that while the attention is always on the gross fiscal deficit, there is a much more meaningful consolidation happening at the primary deficit and the revenue deficit level. If you look at the fiscal deficit in the months of April to January compared to the previous years, in the last 3 years, the actual fiscal deficit based on data from April to December, in fact, it is not April to January, April to December, I think we have basically the fiscal deficit running only at 68% of revised estimates, as opposed to previous years when it was already well overshot the estimates. Quality of expenditure, again, the ratio between revenue and capital expenditure has steadily been improving, and this is also evident in the absolute numbers. Overall, effective capital expenditure, which includes grants for capital creation, has shown an increase of about 3 times in the last 6 years if we include the budget estimates for the next financial year. On your right side, you can see, of course, central government capex for 10 months of data, again, even from financial year 18-19 all the way to 22-23, we do have 5.7 lakh crores compared to 4.4, 3.6, etc. in the previous years, which is naturally not only improves potential growth, but also crowds in the private sector to invest. And that is what we saw in the GDP data as well. Capital formation had indeed picked up. Corporate tax collection, direct tax collections, April to January, much higher than the previous years, both personal income tax as well as corporate taxes. And the GST collections, as you can see here, the April to January average on the right side, financial year 2022-23 is running well above the average of 1.2 lakh crores. Now we're talking about 1.5 lakh crores average. All of these are also indirect indicators of buoyant economic activity, stressing once again the fact that we need to abstract from quarter-on-quarter fluctuations and look at the bigger picture. Overall outlook for the current financial year, India is having a GDP forecast of, this is for 23-24, India has a GDP forecast of about 6.5%. And an inflation outlook. So high GDP and low inflation among large size economies. And for next year, our forecast for 6.5% is well within the norm, or well within the range of forecasts that others have put out, ranging from 5.7 of OECD to 7.2 of ADB. Our official numbers of real GDP at 6.5% is quite well within the range. And if you look at the downside risks to 23-24, they still do prevail. And in fact, the economic survey did point out that downside risks dominate the upside potential to 6.5 because of external situation, that is geopolitical uncertainty, unknowns are plenty. There are risks to current account balance because we don't know how oil prices and food and other fertilizer prices will behave in 23-24, depending on disruptions caused by geopolitical conflicts, caused by weather-related events, etc. And we are also now realizing in the course of February, we have seen that bond yields in the developed world have picked up. US 10-year is heading towards 4%. And there is a recognition in the stock markets as well, which were reluctant to embrace that the Fed could be staying higher and longer. And that expectation is now getting priced in. So we need to be prepared for tighter financial conditions globally, weather-related uncertainties, geopolitical factors, all these things need to be watched. So in some sense, 23-24 may not see a big ticker shock as we saw in the early months of 22-23 because the war had just broken out in February 2022. But nonetheless, some of the underlying factors are still simmering and we need to be watchful about that. At the same time, there are upside risks as well. That is why the range is from 6 to 6.8 rather than, saying 6.5 is the upper limit. There is an upside potential, and that comes from, let's say, limited impact on crude oil prices. Maybe in the second half of the new financial year, monetary policy may come to a halt in terms of tightening in the developed world and may even reverse in the second half of Indian financial year, leading to improvement in capital flows, leading to even lower oil prices, etc. And weather patterns may not turn out to be abnormal. And if we have a normal monsoon and a good harvest, etc., food inflation will become contained. So these are all the potential upside that we have. So I will stop my remarks here and I leave the floor open for you to ask questions. Thank you very much.
Thank you, sir. We can start with Arup Roy Chaudhary. Please unmute yourself and then ask the question.
Dr. Nageswaran, good evening. Am I audible? Am I audible? Hello, am I audible?
I can't hear you.
Please unmute yourself.
I have unmuted myself. Am I just a second. Am I audible now?
Not able to hear you.
Am I audible now?
By the time you sort out your issue, we can have Sapna.
Yeah, ma'am. Good evening. Hi, sir. Very good evening. Sapna Das here from CNBC.
Unmute yourself.
I am unmuted, ma'am.
Ma'am, I can hear them loud and clear.
Yeah, Sapna, could you hear me?
Yes, I can hear you, Arup. Can you hear me?
Yeah, I can hear you as well. I think the issue is from their side.
Can't hear you, Sapna.
Ma'am, I'm completely unmuted.
We can hear each other. I think the issue is from the system.
I think the reporters among ourselves, we can hear each other. Maybe you can't.
Just hold on. Maybe we want to check, make sure that the issue is not at our end. We just want to make sure. Huh?
Achha, they can hear her. We're just sorting it out.
Nirbhay, mark your copy to us.
Please bear with us. We just are sorting it out. Okay.
I think, Arup, can you try now?
Hello, sir. Am I audible now?
Yeah.
All right. Dr. Nageswaran, good evening. Sir, I would like to draw your attention to some very specific numbers in today's data. For Q3, private final consumption expenditure, and this is simply as a share in GDP, whether a nominal or current, whether in nominal or real terms, they have come down year on year. As a share percentage of GDP, private file consumption expenditure has slightly come down in real as well as nominal terms. So does this indicate that while demand is still there, the post-pandemic pent-up demand has finally petered out?
No. If you look at the absolute terms, the growth rate is there. I mean, private final consumption expenditure has increased from 24.3 lakh crores to 24.8 lakh crores, etc. And overall, that's why I said in India, because our data are not seasonally adjusted, I wouldn't read too much into quarterly data. But the fact is that they are within the ballpark of around 60%, etc. And we also have gross fixed capital formation growing year on year, etc. So I wouldn't read too much into quarterly fluctuations here, Arup.
All right, but generally, given the quarterly number of 4.4, the quarterly growth rate, while growth is still there, is there any case of it being uneven because of the pent-up demand having petered out? There is still demand, but would you say the post-pandemic pent-up?
I wouldn't call it petering out. I would call it that there is a return to steady state, and Mosby also has clarified that the growth rate. Now that everybody is audio is working, please mute. Those of you who don't speak, please mute yourself. Thank you. I wouldn't call it petering out as much as steadying growth rate after the spurt. So you have to account for the statistical base effect, and some of it is also due to the upward revision to the previous year's numbers.
All right. That's my question. Thanks.
Sapna, yes.
Yeah. Sir, you mentioned that, maybe because of the possibility of the El Nino that has been spoken about, though IMD today has not really said much on that. You did mention that maybe some monetary policy measures as well as supply side measures, we may have to be prepared with those in the next financial year. Could you give us a better handle and a better context on what you are saying? Because it more or less, I think this issue has been raised in the economic survey also. That's one second. And second, sir, you did say that, even in the last quarter, we can easily grow at around 4 or above 4, and that is all that is required to meet our 7% growth forecast for this year. So are we in the clear this year, despite some of the indicators showing a downward trend?
Yeah, on your first question, I have nothing more to add to what I said already. It is about the risk factors and how, like last year, depending on the kind of shocks that we see, whether it is fiscal or monetary or both, that decision and that call will be taken by the appropriate authorities at that point in time. There's nothing more to add to what I said.
Is there any thinking at this moment also, sir, if I may interrupt?
Sorry?
Is there any thinking at this stage as well, if I may ask?
Is there any what?
Is there any thinking at this stage also, if I may ask?
No, as I said, there's nothing more to add to what I said. And as far as the current financial year is concerned, yes, I think we are I feel we are very, very likely to hit the 7% growth target in real terms for 22-23.
Shishir Sinha.
Yeah, good evening, sir. Shishir here. Am I audible?
Yeah.
Am I audible? Okay. So my question to you that we have seen the manufacturing degrowth in Q2 and Q3. Is this the impact of continuous rise in the interest rate?
See, if you look at the corporate profitability, it is quite good. And if you look at the core industries production, it has rebounded. I don't see this, and in real terms, I would say as the economy, and I also refer to the fact that the purchasing managers indices are comfortably running at well above the expansion zone of 50. So if you, and then you look at the eight core industries production data, as I mentioned. So I think I wouldn't read too much into this. I think overall the manufacturing sector, if you look at the GVA data as well, overall there is a recovery, especially in current prices, etc. So some of it could be due to the input cost and uncertainties that we faced in the first and second quarter of the calendar, in the second and the third quarter of the calendar with respect to input costs, etc. So again, I would say there are as many number of indicators that are pointing to continued robust activity as this data, and some of them are more high frequency indicators. So
Saurabh Shukla.
Yeah.
Saurabh Shukla. Saurabh Shukla. If he's not there, then Monica.
Hello, sir. Sir, I'm Monica here from the New Indian Express. Sir, I want to know that why private consumption is still a concern when there has been a significant growth in the government capital expenditure. Can you throw some light on that, please?
Private consumption is a concern. Who said that?
Sir, all the experts say, all the economists say.
Well, private consumption, as you can see here, private final consumption expenditure is indeed recovering. Every quarter you are seeing the data in the current financial year is showing an uptick, and the average levels of the previous years are definitely much lower than the current financial year. Yes, there will be, and I showed you data on commercial vehicle sales, two-wheeler sales, tractor sales, passenger vehicles, air traffic, etc. So I think, yes, not all segments of private final consumption may be growing at the same rate as some, but definitely overall, the positive segments of the private final consumption expenditure seem to be much more robust and healthy than those which are lagging behind.
And so, what about the private investment? How optimistic are you about improvement in private investment given the current scenario?
Right. We did have it in the survey. We covered it based on data available from because companies are not required to provide cash flow reports every quarter. They only do it twice a year. So based on their cash flow, then you can infer their investment activity. And in the first half of the current financial year, the private corporate sector indeed had invested 3.3 lakh crores, and which is much higher than the 2.7 lakh crores that was done in the previous year, which is higher than the 2.1 lakh crores in the year before. So private capital formation activity is recovering.
Okay.
Shubham Rana from the Informist.
Hello, can you hear me?
We hear you, please.
So I just another question on private final consumption. So where